And thanks for inviting me. No, really pleased to be able to talk on this. So if I get started, I've got a few slides to share during the presentation. I'm also going to be sharing some of BMLL's products and showing you visually some of the things that we want to talk about. So the topic today and the area that I want to talk about is level 3 order book data. I'll explain what that is. I'll talk through what we do at BMLL and how we utilize that, and then using this data and analytics to talk through European microstructure and US microstructure and some of the similarities and differences that we see. It's a fairly broad and hot topic at the moment. There's a lot of regulation coming in both sides of the pond, diverging in a lot of ways. So there's a lot of interesting features you can start to see in the data, and a lot of valuable things that practitioners have to understand from a best execution, from a regulatory compliance, from an alpha generation point of view. So I'll talk through some of those different use cases and explain a little bit about some of the key features that we see within the European and US landscape. So before we begin, what I want to do is spend a few minutes just explaining who we are at BMLL, what we do, and what some of the use cases are for the products, and then I'll sort of dive into some of the key features on the landscape. So BMLL, we are a full depth historical level 3 specialist. We take, and I'll explain what level 3 is in a minute, but it's essentially every single order, the most granular record of data that comes across on exchange-driven markets. We focus on equities, ETFs, and futures, and for this talk, I'll be focusing on equities and ETFs because that's where a lot of the structural changes are happening at the moment. We take that data directly from exchanges at its most granular form. That's every single insertion, cancellation, correction that happens. We then curate that and make that data set consistent over time and across venue. For context on the size and scale of this data, we take terabytes a day. This is a petabyte scale data lake. A large single equity might have 20 million update rows, update messages in a single day. There are 8,000 securities in the US, a similar number in Europe. It's a skewed distribution, but that gives you a sense for just quite how many messages we're processing through, handling, dealing with. Once we've normalized and harmonized that data, we store it in the cloud and then have a suite of products that allow users to come in, query that data either directly or look at different analytics to understand that. And we have customers across the buy side, across the sell side, across exchanges who use our data for granular research of the microstructure of what's going on deep within the order book, using it to either monitor or develop their algorithms from a market making or an execution point of view, analyze and understand the competitive landscape of markets, and then turn that into marketing, product development, and really across the entire value chain of the capital markets, equities and futures trading landscape. So what do I mean by level 3 very quickly? So there's the sort of a lot of vendors and a lot of people who are interacting with the order book and trading on an exchange will typically get what we call a level 1 view of the market. That will be, this is the best price that is quoted, this is the best bid, this is the best ask that are quoted, and they'll see the trades that are there as well. And that's what you can see here on the left-hand side of this screen. More sort of advanced participants will often utilize what we call level 2 data. That means as well as seeing the best price, you might see the best 5, the best 10 levels of the order book at the same time. And this will be event by event. Again, it gives you more granularity. It gives you more understanding. What we do at BMLL is provide what we call level 3 data. That means we get a view of every single order that has come through in the queue. So rather than just seeing, there are 100 shares at $99, we actually see, you can see, and we normalize this, and this is really the unique thing that BMLL has done. We normalize that data so you can see every single order that is sitting in the stack. So you can know exactly what an order has done through the lifetime of its order, how they've changed over time. Now, what a lot of our participants do and what a lot of our customers do is then combine that data with the order IDs that they get when they interact with stock exchanges to turn that into a view of how every single one of their orders is interacting in general with the market. And that's how our participants utilize and use this additional data set to help them drive value and talk through some of the use cases that are there before. So what I'm going to start with now is taking a step back and looking at trades and really thinking about and talking about how US and European market structure behaves, how it's all pieced together, and what's going on. So I'm going to start here with a great little diagram actually from NASDAQ, just explaining how the US equity market is pieced together. So in the middle of this diagram, you have exchanges. These are, public, both pre-trade and post-trade transparent. So we see the quotes that the orders that participants are submitting, as well as trades that happen due to those orders. They quote on what we call the Security Information Processor, the SIP, which is the US consolidated tape. Their quotes that they form on these individual venues will then be used to form what we call the NBBO, the National Best Bid and Offer, which is a consolidated view across all of the different exchanges that are available. Now, at the moment, there are 16 exchanges in the US market. You've got NYSE and NASDAQ, which you've heard of. They have varieties of different exchanges that might offer different fee structures, different venues for trading. There's also CBOE, which comes from the options world originally. And then there's a series of other ones. There's some more recent exchanges that got added, such as MEMX and Miami in the last few years. So there's a range of different venues then. They're what we call the on-book data. On top of that, what we've got the non-exchanges. Now, these can't trade, these have certain regulations around their trading based on the NBBO, so this National Best Bid and Offer. And there's sort of two flavors. So there's the dark pools, which are called ATSs, and then there's the non-ATSs, which is what you'd think of as sort of traditional over-the-counter trading, two people coming together to make a trade and then having to report that ultimately to the SIM. So that is a structure in the US. Now, unfortunately, I don't have a picture in Europe, but Europe in some ways is quite similar, but in other ways is quite different. For a start, there's no consolidated tape in Europe. There's no obligation for exchanges to publish at any particular price. There's no obligation for this around this NBBO for dark pools and for other things. On top of that, there's more transparency in certain parts of the market. So there's these differences. And thirdly, you get something called a systematic internalizer, which I'll talk about in a bit. But this broadly hopefully gives you a bit of an overview of how the US market and the European market is pieced together. Now, what I'm going to show next, and I'm just going to check that you're still seeing that. Fantastic. So what I'm going to show now is, I think, something that gives a really good view of some of the similarities and differences in the US and the European market. And a first one I think is always really important to talk about is the size and the scale. So here I've got a heat map, and this is BML Vantage, one of the visual products that we've got, of all of the trading across Europe and across the US since the start of last year. So little under 15 months. You can see these different identifiers here show the different venues that you can trade on, and I'll talk about this in a minute. The big one is the big blue blob here, which is at SIP, is the traded volume, and this is in all converted into dollars of across the US SIP last year. You can see the size. You can see that it's hundreds of trillions of dollars. Importantly, if you put that together, Europe is about 10% of what the entirety of the US is. So the scale is very, very different. And I think that's always an important thing to emphasize and understand, that the scale of these two markets is vastly, vastly different. Now let's dive in to that scale a little bit and see how some of these things are working in Europe and the US. So what I've got here is a very similar view to what we had on the slide a minute ago here, where we've broken down the different venues. But actually this is showing you, in this case, for the 500, the top 500 names across the US, a granular breakdown of shares over the last few months. And you can see, first of all, we divide between what's on the exchanges and what's off the exchanges. And if we go onto the exchanges, we see there's a few more things we can do. There are auction phases which happen during the exchanges, but the majority of the trading still happens on what we call the continuous period. And you can see we can go down from NYSE and NASDAQ here with very large amounts down to, you know, the very small venues that actually trade. So we've got this breakdown here. We've then got, which is roughly, you know, that's roughly 60% buy on a share basis. This will change a little bit if you use it in dollar terms. One thing to point out, Europe and the US tend to think differently about their report things. So in the US, a lot of reporting is done on a share basis, whereas in Europe and the rest of the world, it tends to be reported in a notional basis. So in terms of a dollar amount. The reason being that, you know, one share of Apple at maybe $100 or $200 is vastly different to one share of Berkshire Hathaway, which might be $400,000 to $500,000. So, but the detailed granular breakdown we get, which we take, by the way, this is taken from a combination of BML's data plus data from FINRA, which reports this information. That's only available on a share basis. But if we then see, you know, within this 60%, you know, broadly, you know, sort of 2/3 of it is sort of on the off book venues, and there's a series of larger ones, Citadel, Virtue, others who have their internalization systems will have larger shares, and then we've got a series of the ATSs, which are essentially dark pools, minimal pre-trade transparency. You can't necessarily see, you only see the trades that happen. You can't see what other participants are quoting, and again, there's a large, deep set of these venues which vary from very large to very small. Now Europe, and this is something that actually BMLL we produce on a monthly basis. It's on our website. You're very welcome to come and look and interact with these what we call our liquidity maps in Europe, and we have that available. In Europe, there's a few key differences. The first one of which is we actually have a lot more breakdown on this on exchange information. For a start, we actually have dark pools which interact in Europe on reporting and trading into the exchanges themselves. You'll see that the auction phase is pretty similar, but we also have this off book on exchange mechanism whereby trades happening in Europe might happen on an OTC basis. It might be without being on the exchange, but is under enough rules that they'll actually come and report themselves onto the exchange. Now, where we see where we see a lot of differences is in the off exchange data. First of all, in Europe, you don't see any sort of breakdown of what's going on these so-called systematic internalizers, but we do see where that's trading. So Europe has, as well as the dark pools that are available, it has a myriad of different apologies, 1 second, my laptop power has cut off just before it died. Yeah, apologies for that. We have a myriad of venues of what are called systematic internalizers. Now these allow people to execute away from an exchange in a private manner, and this was something that was introduced by regulation a few years ago. And what you can see actually, first of all, systematic internalizers do form a decent percentage of this off-book trading, but we also then have what we call this special price, which is a way we've classified data, which is a very large, and actually overall a very large percentage of trading, roughly 20% of the market. Now, this is what participants and practitioners would consider non-addressable liquidity. So there tends to be a pool of liquidity that isn't addressable to a lot of participants in the market, and people tend to discount from calculations. And this is the sort of thing that is very important to understand. It's important to understand how much liquidity in all these fragmented markets where there's lots of different trading mechanisms that someone can actually interact with. So it's very important to eliminate that. So you're actually, from a risk perspective, you're good. From working out, you know, if I need to execute large trades, how much could I interact with? That's all available. I can see actually there's one question on how do you know how much volume Citadel and Virtue do. So this data set, this data set comes from two things. So it comes partly from the SIP data that we take from BMLL. It also comes from FINRA, who provide a month delayed weekly breakdown of traded volumes off exchange. So if you actually take this from the security information processor, all you get told is this is an off-book trade. You do not get told any more information about where that's executed. FINRA then gives some additional transparency on a delayed basis, so you can then work out how much is traded non-ATS on these different ones. So this is what's going on a bilateral non-executed basis. This is not how much Citadel have traded on the lit market, and I think that's important to state. So this is them as a venue rather than them as a market maker or participant. But overall, what you can see is there's a clear view that there is in a lot of ways a similar proportion between on and off exchange. You look at sort of 60-40, but the granularity and the way that you can actually analyze this data is different across Europe and the US. And that's, I think, really important when it comes to thinking about how to interact with this data, you know, from thinking about what might be from an algorithmic execution point of view, from an exchange point of view, if you're trying to understand your share of the market. Understanding what information you do and don't get is really important to be able to answering those questions. And one more thing I thought I'd just show up is, you know, just to highlight and emphasize, you know, some of the ways you can start to do analysis on this. I've pulled up a selection of stocks here on BMLL Vantage, the visual product that we have across both the US and Europe. You can see I've broken it down by what's on Amsterdam, the LSE, Paris, and Nasdaq. So these are sort of the blue chips on those different indices. If I look at the way we can break up and classify trades, Europe actually provides a lot more of the granularity that we can see. So you can see all of these different mechanisms in fine detail, what's going on a systematic internalizer, what's going on other mechanisms, periodic auctions, which is another mechanism, and others. In US, you tend to get a little bit less of that granularity, but underneath, both of these systems are highly fragmented, highly, you know, lots of different trading mechanisms that you can utilize, and part of the challenge in anyone who's interacting with that data directly is utilizing that. So, like, if I go back to the slides now, that's sort of given you hopefully a good high-level overview of volumes. You know, the key thing being the size of the market is vastly different. It gives you a nice breakdown of where liquidity resides on and off exchange. Actually, Europe and US are broadly similar, but there is a big difference in terms of the way these mechanisms behave, the transparency, how they're interacting, and understanding the market structure of that and understanding how that behaves is really important for any participant. So a second big difference, and I think it's actually probably the biggest difference between the US and Europe, certainly in my opinion, is the behavior of this NBBO. So the NBBO has a few important features. Firstly, the NBBO is on a round lot basis. That means that rather than it being one share, and if we go back to our order book, and imagine just an order book, across multiple levels, rather than it being one share that gets contributed, but the NBBO is in round lots, and in the US, a round lot is 100 shares. Typically, there are a few exceptions for very large stocks, but in general, it's 100 shares. So what that means is the top of your book might not actually have 100 shares on that first price level. It might be further down the order book. And the price that you will see in this NBBO is the price at which there are 100 shares on a particular venue, rather than the price there are at one share. And that leads to some interesting phenomena in terms of understanding what volume is trading inside the NBBO. Now, for some participants, and there are certain rules around trading and quoting, but you can effectively allow an exchange, if you put a certain type of order on the exchange is obliged to route it to another venue, even if that venue is not an NBBO. But that will only be the NBBO price. So there may be a venue that has actually got a better price than what the US NBBO, the SIP tells you is the best price in all the venues. And that's what we call odd lot trading typically. So that will be typically a trade that occurs below a round lot side, typically inside that US NBBO. And what we can see here is a pretty steady increase, and actually it's been going up before that, of trades that are occurring below the round lot size. So rather than being above round lot size, it's actually below. So these are smaller than 100 shares. And actually, on top of that, there's been a real increase in shares trading inside the NBBO. It's actually gone down a little bit in the last year since I last used these slides, but it's the point is that it's still sort of a significant fraction of trading that is actually occurring inside NBBO. Now, there's a couple of ways that you can explain and understand this. First of all, and this has been going on for a while, stock prices have been increasing. Obviously, the last year has been a little bit different, but in general, stock prices have been going up a lot, especially in some of the very liquid stocks. So historically, up until around a year ago, Amazon, for example, had never had a stock split. It was trading at several $1,000s a share. Now, several $1,000s times 100 to get a round lot suddenly gives you sort of, say, a couple of $100,000. Now, that is much larger than the size of a typical trade that occurs on an exchange. So typically, when an exchange algorithm goes to try and reduce market impact, trades will get broken up into what you call child orders, and one order for, say, 100,000 shares will get broken down into several child orders. They tend to be around, on average, $10,000 to $20,000 a share. So it's therefore very natural that you should see, especially for these larger share price stocks, a lot more trading inside the NBBO. And actually, this is exactly
a quick question, Elliot, from one of the participants.
Sure.
Who's asking, aren't most stocks trading with a one tick spread? If so, how is their trading inside the NBBO?
That's actually revealing some of the talk I'm going to talk about later on. A lot of stocks will not have a one tick spread. In fact, Apple does. So Apple is quite unusual, which we've got here. Apple is what is known as a tick constrained stock, which means most of the time trading is outside. Most of the time the spread is 1 tick, which means on exchange, you're absolutely right, there can't be any trading inside NBBO. However, for a large percentage of stocks, they don't have a single tick spread, and actually it can be a lot more. So if I take, for example, something I'd actually pulled up here in our data. So this is the BMLO Data Lab. Here is actually and Amazon's a bit of a different story now because it's had a stock split, but here is the story from last year. Here is Amazon, and here is an order book at a particular point in time. You can see, quite rightly, this is on NASDAQ. This spread is 1 tick. So yeah, absolutely. You're not going to see a lot of trading inside the spread. And that is exactly what we see here. There's a small fraction, which might be arbitrage, it might be market makers being nice and quick, but there's not too much that trades inside NBBO. This is the same order book for Amazon. And you can see, because bear in mind, everything in the US is a single tick. A single cent is the tick size. You can see here, there are gaps, and there is sparsity in that order book. There's not just one level at a time. There's lots of space in there. So the chart on that trades, that is just so I see someone just asked a question, does the chart on trades within NBBO include midpoint trades? No, this will just be trades that are occurring on exchange, and therefore won't be executed at the midpoint. Off book and dark pool exchanges can also trade at the midpoint, so that's going to drive an amount of NBBO trades, but this is purely just on exchange trades where you're seeing this happening, and it's being inside NBBO. So what you see here is a lot of sparsity. Now the reason is 1 cent on $3,000 is a very, very small fraction. And actually, a lot of people tend to look at spreads in terms of basis points and what it will actually cost you to cross that spread, rather than in terms of a cent or a tick size. So for something at $3,000, being $1 away as a spread is actually a very small price to pay for crossing the spread, compared to what we see at in the Apple case, where at $150 at this point, 1 cent is a much smaller fraction. So actually, things tend to be bunched much closer, and you tend to see what we call tick constrained stocks. There's actually, for those who haven't seen, there's a couple of great articles by Phil McIntosh explaining in great detail a lot of the tick constraints, and there's certainly some good articles there that are worth reading on the subject and explaining it doing a lot of detailed analysis on it. So absolutely, for these larger price stocks, what you tend to find is because the tick size is so small relative to the size of the price of the stock, actually you get this natural sparsity. And let's be clear, this is Amazon. This is a highly liquid, very well traded stock. This picture isn't there because it's something that's illiquid. People don't want to trade it. Quite the opposite. It's one of the most traded stocks in the US. But the point is that because at this point the share price is so high, participants won't have a frame of reference to look at in the same way. So spreads tend to be wider, and importantly, what it means is the queues and the sizes of an individual order book tend to be much smaller. If there's a lot of sparsity in my order book, then if I want to get to the front of a queue or a particular price level, I just move my quote inside that best price, rather than getting to the back of the queue and trying to place it at the front when, if I want to execute a trade, I'll have to cross that spread. So there's a lot of differences here, but yeah, very much the point is that this is a real phenomenon that you see, that most stocks do not trade at a single tick spread. And this is what we can see here of Amazon. Of course, Amazon now, the picture has changed because it did a 24 stock split last year, May or June last year, I think, from memory. This picture for Amazon looks much more like the picture for Apple. So that's where we are today with round lots and odd lots. But actually, one of the big regulatory changes is coming and looking at changing the definition of round lots to absolutely try and constrain and change some of this problem. So this came out in some of the regulation, and I don't know if you're aware, there's been a lot of regulatory proposals and proposed changes to regulatory structure in the last couple of years, and this is one of the proposals where the SEC are proposing to modify the round lot size depending on the price of the share, so that to reduce some of these views, so it's more like this view. Now, there's actually and I see Petter's put the some of the articles on tick constraints up there. There's quite a lot of research that shows optimal tick size is sort of a couple of ticks typically, because it allows participants to go inside the spread, and you find that you tend to get better liquidity quality when you do that. So there are some regulation changes that are occurring that are coming in to try and shift that tick size, especially for the larger tick stocks. And you can actually see, this is as of March 2023, so the numbers have probably changed slightly, especially since the autumn corrections on equities. But you can see roughly a third of the S&P 500 on a notional basis in terms of how much is traded would be in sizes of tick that are not 100, so they'd be 40 or 10. And actually, one of the things that we looked at here was actually the difference between what that would look like to an NBBO. And again, this is a great visualization, I think, and an important takeaway to remember with the NBBO about how it is actually round lot size. Now, again, I've taken Amazon as a stock. It was a nice tick. It was a nice share price then, and what you can see here is what the bid price would look like at the NBBO. So when there is 100 shares in a round lot, and what it would look like under 10, which if we see on this SEC round lots, this is what the new tick size would look like. Now, an important thing here, $30,000 is much closer to the size of a typical child order than 300,000. And what you can see is there is a natural tightening of the spread. This is the point over the day, but you can see that it naturally tightens because of that, and actually participants are therefore going to see a tighter spread when they look at the NBBO. And bear in mind, this is just on NASDAQ. The NBBO is consolidated across all the venues to get the tightest spread. But what that will ultimately mean, and the idea is that for investors, because dark pools and exchanges are built around this NBBO, the idea is for these large tick stocks, you'll actually see a tightening of the spread, and therefore a better price for participants to get protected prices. Now, there's a lot of active debate over what the optimal SEC rules are. This is not something yet that has come in to be made available. There are debate and discussion going on about the exact amounts, but I just wanted to point out that this is something that will be seen and will be done. And that it certainly it looks like there's a lot of discussion around this, and I think it's important for participants, and a lot of our customers are looking at this sort of information to understand what the impact of this regulation may well be from a trading point of view, from an exchange point of view, from an alpha generation, from a trading strategy point of view. So that's round lots. Now, Europe is very different and is actually a completely different story here. So for one, there is no consolidated tape. There's no NBBO or EBBO in Europe. That's no regulatory EBBO. There are lots of people who will construct their own for one reason or another, but there is no consolidated tape that provides an EBBO equivalent to the NBBO in Europe. And there are also no round lot sizes. The round lot size in Europe is 1. So there isn't the same type of questions around round lots, around aggregations. That just isn't a problem in Europe. What you have instead is you have no trade for rules. So exchanges can be out of sync with each other on an NBBO and EBBO basis, which creates a different set of challenges and understanding. But unlike the US, there's none of this round lot rules that participants have to understand. Now, we spoke about tick sizes before, and this is a big, and this is another big area of focus, and is worth understanding the difference in tick size between Europe and the US. And we've already spoken a little bit about tick constrained stocks, and I'll talk a little bit more about them. But a big thing to point out and understanding is the EU has dynamic tick sizes. That means the tick will depend on a few different factors. It will depend on how much is traded, and under MiFID, which is the European regulation, there are certain, depending on how many trades, there are different tick sizes to try and encourage less or more liquidity to try and tackle the tick constraint problem that Petter's pointed out in that article. But it will also vary on price. So as prices change and increase, the tick size actually gets smaller. The idea being that your tick in basis points remains roughly constant. Now, this is clearly a different approach to the US, and it has some different and interesting challenges to what we see in Europe, in the US. So I'm actually gonna talk and show an example of, if you're not aware of tick sizes and you're just looking at the top of the order book, some of the challenges that you can see in Europe. So here I've picked Banco BPM, so an Italian stock. It's a liquid stock. It's one of the sort of top end stocks in Italy, and I've got here the average, basically the average number of share, the average notional sitting on the best bid over the day. And this is a couple of years ago. You'll see why in a second. There's a specific reason for that. So what you can see here is, there's sort of around 20,000 euros of notional on average at the best bid over the day, and then suddenly we get a jump to 60,000. It happens pretty quickly over a couple of days, and then the liquidity stays there pretty constant. Now, a general rule of thumb is a more liquid stock will lead to more liquidity at touch. That's how people think about it. If it's more popular, people want to trade it more. Market makers are more willing to provide liquidity because therefore, they're more likely to be able to manage that liquidity. So you might be tempted to think that what's happened here is there's been a liquidity event. People are trying to trade a lot of that stock, either up or down. But actually, you'd be wrong if that's what you're thinking about. And actually, the reason there's been this big shift in the amount of traded at touch, and by the way, this would look the same if we looked at the shares rather than notional. You'd get the same picture. So let's look at a couple of other things. Firstly, I've got the spread, and now this is a spread in basis points. So this is a spread in terms of relative to the midpoint. So rather than an absolute spread, this is the spread in terms of the relative to its share price. And what you can see here, there's been absolutely no change. you know, you would not be able to see from looking at that in any way that there's been any sort of liquidity change, anything has happened materially to that stock. So the answer lies in this dynamic tick pricing. So let's get the price up. And what we can see is, you know, this jump occurs between the 4th and the 8th of February. Over the 4th to 8th of February, the share price crossed from under €2 to over €2. So if we go back to our tick rules, we can see actually there is a change in the ticks that occur when the share price goes between under 2 to over 2 €2. So what's happened is the price of the share has gone above this certain size. Therefore, the spread has actually got wider because the ticks there are wider. So therefore, because now the spread in ticks is actually wider, and we can see this if we look actually at the spread in ticks, which is here, we can see the spread in ticks has actually gone, you know, the size-wise, actually more participants have piled in to the first level of the order book in order to keep that spread in basis points, which will actually manage the cost of trade constant. And this is the sort of thing that comes up when you have dynamic tick sizes. So when you get around that boundary of a tick size, and this is a common in Europe, there are other jurisdictions where you see this. So Japan has a level of tick sizing. Europe and the US are probably the extreme in this, so there's sort of a range in between. But one gotcha of dynamic tick sizing, which you see in Europe, is that around these boundaries, liquidity, especially if you're only looking at the top of the order book in isolation, can actually change over that boundary.
A quick question here to clarify for everyone, Elliot.
Yeah.
The tick size does not change dynamically intraday, right? It changes the following day. Is that correct?
Yes, I believe so. So it's set on an ADV basis.
That's right.
So yeah. So that will go through. So yeah, this will be set for the day. But you can see around what's going on, these sort of changes, and the key thing here is the average price is going from below to above that, too, and therefore you're getting this shift across. Some countries it will be completely dynamic, and therefore it can actually, you can have imbalances on sides of the order book as well when that occurs. So yeah, some and I think some in Europe, I think they can be dynamic as well, Petter. I'd have to go and remind myself on exactly the dynamics of them, but some will be completely dynamic as well. So you will actually see, if you look at the order book, one side of the order book will actually have tighter spreads than the other, and I think you can see sometimes when you do this that the order book actually shifts. You have some interesting dynamics because you have different ticks, you have sort of an asymmetry in that, but things tend to move away from that quite quickly, the exact amount.
Interesting. Yeah, thank you for that.
Fantastic. So this is Europe. Now US, we've already sort of mentioned the tick constraint problem. So someone actually jumped the gun on this particular one. Thank you for that question. But actually, this is a visualization of exactly what we see by the tick constraint problem. So here I've pulled a bunch of basically the NASDAQ 100, and I've plotted the VWAP against the spread. And what you can see is this pretty familiar pattern. You'll see it in the article that Phil linked to as well. Sorry, Petter linked to as well to Phil's article, that you get this sort of sweet spot. And obviously different liquidity stocks have different spreads, but you see around, in this case 200, and it tends to be around this point with a single cent tick, that spreads actually are higher here. Now the reason they're higher at lower prices is because beyond a certain point, even if you want to have a spread that is tighter in basis points, you can't, because physically 1 cent of $1 is a lot more than 1 cent of $1,000. So the cheapest you can move is going to be constrained. And as we get further out, what we see again is, because there's no dynamics in the order book, and it's easier, rather than to sit on a particular price level, just to move 1 tick, and that's such a small amount, actually you find there's a wider spread there as well. So this is a nice visualization of the tick constrained problem that we spoke about before, and how those dynamics work with each other. So the last thing that I wanted to talk about a little bit, and I'll spend a few minutes on this, is we haven't really spoken about yet, is ETFs. So ETFs are, there is a big difference in Europe between Europe and the US between how ETFs actually behave. So one thing that I'll just get back up to this. One thing that before I go into this, I will just let me get this. The ETFs in Europe behave quite differently to ETFs in the US. So in the US, they are treated essentially as stocks. They are for all intents and purposes, from a reference symbology point of view, they are the same thing. You'll have an ETF, you'll have a ticker, it'll be exactly the same thing. In Europe, it's quite different, because ETFs will list on multiple exchanges at the same time. So rather than a single venue which they'll list on, they'll actually list on 4 or 5 European venues at the same time. And I'm just going to get up one of those examples just to show you, and it's just touching on the subject of ETFs, which are a complicated product in their own right, and there's lots of interesting studies on this. But here I've pulled up an ETF in the US, and I'm gonna show a single metric here, and we're gonna see, first of all, these are all the different venues where this one Vanguard S&P 500 ETF is actually listed. So you can see, not only has it listed on, not only is it's listed on multiple primary venues with one ISIN, which means actually finding where this symbol trades is difficult. And importantly, it's actually also listed in multiple currencies. So you can see there's a separate listing for the US dollar one versus the euro one versus the pound ETF, depending on who wants to actually trade these ETFs. So, and in the US, in contrast, SPY is only on ARCA, and is therefore a much simpler problem. So what you see in Europe is a lot of fragmentation of the ETFs for that reason. There tends to be a lot of fragmentation of liquidity. There is also, and we don't yet have it on BML Advantage, we'll be adding it, a lot of off-book trading that is driven by RFQ. So Tradeweb and Bloomberg tend to be very large mechanisms which are not exchanges, and not exchange driven, but are quote driven, which allow users to trade ETFs. So I think that's always just a final point just to talk about a little bit, is that there is a big difference when you're thinking about ETFs and equities in Europe to the US, where they're kind of, for a lot of use cases, considered as extensions to the stock. So that really summarizes what and I think that's where I'd like to stop today. What I've hopefully done is given you a bit of a flavor for the types of problems that we see in Europe and US market microstructure. We've looked at volume comparisons between Europe and the US. We've seen Europe is much larger. Both are fragmented, but in different ways and have different levels of transparency of what you can see is traded. We then looked at odd lots and round lots and how understanding them is really important, especially in light of the regulatory changes that are coming on. We've looked at the comparisons of tick sizes across US and Europe, and then finally looked at the comparisons of ETFs and how they behave differently in Europe and the US from a sort of reference data and a dual listing perspective. I showed you BML Advantage, the data lab as well. We're very happy if anyone wants demos of the product to utilize that, very happy to provide that. Hopefully you've given a flavor for the types of analytics that the order book data can give you. But thank you very much for listening, and I'll now take any more questions.
Thank you very much for this really great presentation, Elliot. Very insightful, especially the contrast and comparisons between US and markets in Europe. We'll give Elliot a round of applause, virtual applause, as is appropriate for this occasion. Here we go.